The big news on that was that the Federal Chair, Jerome Powell, hinted that this might be the last cut for this year. That was a change of plan from what everybody was expecting, because they were expecting another December cut. Let's look at gold and see how that's doing. There's your peak at $4,380, and you can see it's come off here. Now it seems to be trading potentially in a sideways range. It might go lower. I mean, it could easily retrace to 3,500.
Gold dropped sharply on the open on COMEX and the futures. It dropped to 39.62. So it's quite encouraging that it's rebounding, especially on the Monday, because a lot of times we see gold being hammered or slammed overnight from Sunday to Monday, and it continues. And there's a story about the Chinese government implementing new VAT policies for gold. There's a lot of confusion about it.
Gold's recent price movement is telling a deeper story than daily market reactions might suggest. After reaching highs near $4,380, gold has entered a consolidation phase, testing key levels while maintaining its long-term bullish trajectory. Despite temporary volatility, the broader signal remains clear. Investors are beginning to favor tangible assets over paper wealth as confidence in fiat-based markets weakens. Meanwhile, shifting interest rate expectations and mounting global debt are amplifying the appeal of precious metals as both a hedge against economic uncertainty and a measure of systemic health. The Dow-to-gold and gold-to-S&P ratios, historically reliable indicators of capital rotation, are once again flashing strong signals of a transition away from inflated financial assets toward real stores of value. Marioinnecco and Clive Thompson, seasoned voices in the precious metals and macroeconomic space, highlight how these ratios have historically marked the unwinding of credit bubbles. The patterns unfolding today mirror those seen before major financial resets, suggesting we are in the early stages of another such shift. Gold's resilience above critical support and silver's slow but steady strength reinforce this long-term trend. As monetary policies tighten and global trade structures evolve, the revaluation of tangible assets is becoming not just likely but necessary. The message is simple: the financial system is recalibrating, and gold and silver are once again taking their rightful place at the center of that process. Investors who understand this shift see opportunity where others see noise, because beneath the volatility lies a generational realignment of value and trust. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
And every time the Dow-gold ratio, which basically is how many ounces of gold you need to buy one Dow Jones Industrial Average, it had crossed below that 7-year moving average. And every time, 3 other times in the last 100 years or so, that signal a great unwinding of the previous credit bubble. And as you can see by this chart, I said that I thought the last credit bubble started after the '08 crisis. And yes, the Dow-gold ratio did rebound above that 7-year moving average, as you can see, back around 2012 or 2013. And it stayed there pretty much until recently, even though it dropped below that moving average back in 2020. We know what happened in 2020, of course. And then they came in and they threw even more funny money and borrowing into the system. And that's why the Dow rebounded above the moving average. But it's completely failed now. And the other thing that I noted the other day, because Friday, the last trading day before today, was the end of the month, and this is a monthly chart. You notice that we actually closed back below this trend line, which is really important. A few months ago, it closed below it, and then it rebounded above it, and now it's gone back below it. I think it shows that the trend is lower. And what does that mean? Well, it means that gold and silver, for that matter, don't forget silver, will outperform financial assets, i.e. Common stocks and government bonds and corporate bonds going forward. And I think we could accelerate a lot lower. This ratio can be quite sticky, but once it turns, it can move very quickly. It could be a matter of 18 months to 2 years, I would say here. It sounds a long time, but if you think in a matter of days and weeks, I think you're in the wrong game, investment game, or safeguarding your savings game. So yeah, I'm still convinced we're going to see this ratio back down towards 1 or 2 to 1, or maybe even lower, because ever since the early 30s, when this ratio has bottomed, it has been at lower levels, and when it has topped, it has been at higher levels. There's like a megaphone formation. So yeah, very bullish, I think. But there is another ratio which is really important too, is the gold to S&P ratio. It's the same kind of thing, but we look at it in terms of gold instead of the S&P. And as you can see by this chart, another monthly chart, gold, you could buy 8 S&Ps almost with an ounce of gold back in 1980. And then gold bottomed in terms of the S&P. You could only buy 0.185 back in the early part of this century. And then gold rallied strongly up until 2011, and it's been basing ever since. Really, there's been a bear market in gold versus the S&P, but I think now it's turning. And the interesting thing is that in the last, I think it was back in April, it started taking off, gold to S&P, and then it came back down sharply, and it actually retested the breakout area, which is very positive. Technically, and now we're going back up, so we need to keep an eye on this. I think if we break through 0.7, that's very bullish, and that in of itself will also help the Dow to gold ratio, because I think right now it's one of the reasons the Dow gold ratio hasn't dropped even more, is because gold to S&P is still not clear, but I think we're getting there. And at what levels will, let's say, the Dow gold ratio be if we go 1 to 1? It's difficult to say, of course, but it's all relative, right? You'll be able to buy a lot more financial assets when that happens. And I want to emphasize that I don't believe having gold is the end all, but it's very important in this day and age. Where the system is teetering on the edge, the financial and monetary system. But eventually, it will be good to invest your money, real money, in, let's say, productive assets. But I think we're not near there yet in terms of value. I think you can wait, and that's my opinion. When it gets to 1 to 1 for the S&P, I think there's still a lot of room as well. If we get to 8 S&Ps to 1, 8 S&Ps to 1 ounce of gold, that will be good too. It could go even higher. And let's check out gold first, as we always do. Spot gold is at 4,024, up $21. I noticed overnight, late last night here, London time, that gold dropped sharply on the open, on COMEX and the futures. It dropped to 39.62. So it's quite encouraging that it's rebounding, especially on the Monday, because a lot of times we see gold being hammered or slammed overnight from Sunday to Monday, and it continues. And there's a story about the Chinese government implementing new VAT policies for gold. There's a lot of confusion about it. I'm not going to talk about it now because I'll be interviewing Eric Young, or aka King Kong 9888, later on today, and he's going to tell us all about it. Because there's a lot of misinformation in the financial mainstream press in the West. People like Bloomberg and, let's say, CNBC and so on. So what about silver? Well, silver is doing quite well. I mean, relatively well. It's still not going gangbusters, but I think it's only a matter of time before we go back above 50. We're at 49.05, up about 40 cents. Spot silver, high's been 49.10, low has been 48.20. The stock market indices, we've got the Dow futures up 1/8%, S&P same kind of gain. NASDAQ 100 future, that's up 1/4%. The currencies are virtually unchanged, really, versus the dollar. And in terms of the bond market, U.S. Treasuries, the 10-year is unchanged as well. It's at 4.10. So yeah, we've gotten back above 4%. The 30 years at 4.67. Why has that happened? I think it's because in the last FOMC meeting last week, the Fed tamped down a little bit the expectation of rate cuts, especially for December. So the market's kind of concerned that the Fed wants to try to control inflation a little more, and that they're concerned about inflation.
Gold has eased from its recent highs near $4,380, entering what appears to be a healthy consolidation phase after an impressive run. This sideways movement is not a sign of weakness, but a natural breather in an ongoing structural bull market. Markets rarely move in straight lines, and this current pause could be the market's way of absorbing gains before the next advance. Even as short-term volatility persists, the fundamental case for gold remains strong, supported by persistently high debt levels, shifting central bank policies, and global diversification away from fiat currencies. More significantly, institutional money is beginning to take notice. Portfolio managers and wealth funds are recognizing that gold has not only outperformed in absolute terms, but has also lowered overall volatility in diversified portfolios. That data alone is powerful and will likely drive renewed institutional inflows into gold allocations heading into next year. As capital flows adjust and macro uncertainty persists, gold's quiet stability continues to stand out amid the noise of financial markets. Whether measured in dollars, euros, francs, or pounds, gold's steady resilience signals the return of real value in a world of inflated assets and waning confidence. Let's get back to the interview.
Gold came off from its highs of, the high point was $4,300, or roughly, maybe some people said 4,380, which was set on October the 20th. Let's look at gold and see how that's doing. I'll bring that up on the screen. So here you see the gold price. There's your peak at $4,380, and you can see it's come off here, and now it seems to be trading potentially in a sideways range. It might go lower. I mean, it could easily retrace to 3,500. By the way, this is not investment advice. It's just a personal opinion. But I think we're sort of getting towards the end of the year, and I think it's quite likely that next year many investment managers will decide to add gold as part of their asset allocation strategy. Why will they do that? Because the maths will prove that had you had gold in your portfolio over the last few years, it would have reduced volatility and improved returns. So mathematically, it makes sense to put gold in the portfolio. And I know it's weird to make these decisions after the event rather than before it had happened, but that's the real world of the markets. They constantly look at the past, analyze what asset allocation would have been best, and then make the next asset allocation like what would have been best in the past. So yes, I think we'll have gold going into portfolios next year, small allocation. They'll decide that's a good thing. So probably as we go forwards to the year end, we'll have this volatility up, down a little bit, but more of a sideways movement. I mean, so probably we go right through to perhaps Christmas, but at some point towards the end of the year, I expect people to anticipate this move by investment managers as gold gets added to the asset allocation for 2026. So we might get a strong end of the year rally. Again, not investment advice, I'm just saying what I think might happen. And then, of course, if once it's in the asset allocation tables next year, probably gold can continue its longer-term rally. Gold is doing very well today. Well, reasonably well. It's up $11. It's at $4,014 as I do this, and it's rising in Swiss francs, there in euros, in Japanese yen, and let's look at pounds. So in British pounds, the price is at over 3,054. Not forgetting the peak in British pounds was 3,260, let's say. So we're £200 below the peak for the British investors. And we're going to talk about it in a minute, but I'd just like to remind UK investors that if you want to hold gold in a UK self-invested pension plan, it is possible.
Gold's recent pullback from its October peak near $4,380 has caught attention, but what's really happening beneath the surface is far more strategic than emotional. After a significant run, the metal is now stabilizing within a consolidation range, quietly setting up for its next important move. Long-term momentum continues to favor tangible, scarce assets over leveraged financial products, with central banks buying record amounts of gold and global monetary policy shifting toward real collateral and trust-based assets. The stage is being set for an institutional revaluation of gold as a core portfolio holding. Heading into 2026, major fund managers are expected to integrate gold into diversified asset models, not as speculation, but as a mathematical necessity. Backtesting already shows portfolios with gold exposure achieving more substantial returns and lower volatility than traditional 60-40 models. That realization will drive fresh demand, especially as global debt continues to expand and fiat systems weaken. Meanwhile, currencies across the board, from the euro to the yen to the pound, continue to lose purchasing power relative to gold, further confirming the metal's role as the anchor in this new financial era. The smart money is preparing quietly. Gold's moment isn't over, it's evolving. As global capital rotates toward real value, those positioned early stand to benefit from what could be the most significant wealth shift in a generation. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.